Coming up on Retiring Well with Michael Reese.
So who's making money on who here? Is Bill making money on the IRS? No, it's the other way around. Good news, what can you do? Buy out your partner at any time. You can do Roth conversions. Get the IRS out of here, take your money, and then grow it so that 100% is yours. The IRS assesses a 50% penalty on you for not making your required distribution. And then you got to pull it out and pay income tax on the whole amount anyway.
Now, the host of Retiring Well, Michael Reese.
Welcome to the show today. We have 30 minutes of action-packed information specifically designed for you. Retiring Well starts right here, right now.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
This week on CFP Talk, I want to share with you a discussion that I have with folks about their IRAs or 401ks or even 403bs all the time. You see, one of the biggest mistakes that people make with their tax planning has to do with their IRAs. So let's look at an example of what I'm talking about. Let's imagine that I'm talking to someone whose name is, let's call him Bill. And Bill has a $500,000 IRA or a $500,000 401k, 403b, what have you. I'll just use IRA for our discussion today. So Bill comes to us and he shows us his statement. And in his IRA, here's what it says on the top. It's titled Bill's IRA. And then at the bottom, right there at the bottom of his statement, it says $500,000. And so the question is, does Bill have $500,000 in his IRA? Does he have $500,000? Well, let's think about this together. So let's imagine that Bill here decides he wants to go buy a house. Maybe he wants to buy a second home. And it costs exactly $500,000. So here's what he's thinking. He's thinking, well, hey, I've got $500,000 in my IRA. It says so right there on my statement. So here's what I'm going to do. I'm going to cash out that IRA. I'm going to get my $500,000 and I'm going to use it to go buy that house. That's what I'm going to do. Well, if Bill does that, does he really get $500,000? Does he, when he cashes out that IRA, will he receive $500,000? Well, you know what the answer to that is. The answer is, of course, no, he will not. What will he get? Well, he'll probably get something closer to maybe $350,000, something like that. Well, wait a minute here. Where did the other $150,000 go? Well, this is what Bill gets. The other $150,000 over here, that went to the IRS. So when we look at this $500,000 IRA, is it really all Bill's? Can he get all that money if he wants it? Well, no, it's not. This is not all his money. He looks at that statement, he sees $500,000, it's not all his. See, if we were really being accurate about things, here's what this IRA would be titled. It would really be titled Bill and IRS's IRA. In other words, this IRA, it's kind of like Bill is in a business relationship. This IRA is like a business. Bill owns $350,000 of that business. The IRS owns $150,000. The IRS is like that silent partner. And I know what everybody says. I know what you've been taught. You've been taught that this is okay because as this IRA gets larger, as it gets bigger, well then, Bill's making money on the IRS's money, right? Bill's making money on their money. That's what you've been taught. Unfortunately, in a lot of cases, that's wrong, and here's why. Think about this relationship right now. Think about this. Right now, Bill is a 70% owner. The IRS is a 30% owner. What if this thing grows to $2 million over time due to Bill's hard work and investment smarts? What if it grows? At $2 million, because the tax code, the more money you have, the more you're taxed, now Bill only owns about 60%, and the IRS gets 40%. Who made money on who here? Who made money on who? What happens is the bigger your IRA gets, the bigger chunk, the bigger percentage the IRS gets. So who's making money on who here? Is Bill making money on the IRS? No, it's the other way around. Good news, what can you do? Buy out your partner at any time. You can do Roth conversions. Get the IRS out of here, take your money, and then grow it so that 100% is yours. This is something you really want to look at. Now, if you have any questions about this or anything else we talk about on the show, by all means, please give us a call. We'd love to talk to you.
Since 2000, we have seen the market drop to half its value a couple of times. We are now in the second largest bull run of all time. Is the bear poised to strike again? Many are speculating that it is, but we are not going to take that position. The truth is, no one can predict when because they always come unexpected. The key is being positioned to handle it no matter what happens.
By objective, a mutual fund will hold the securities it said that they would hold in the prospectus. For example, a large cap mutual fund is going to hold large company stocks. If the market crashes like it did in 2008, then what does that large cap mutual fund do? Think about it. Will they go to cash?
You will be hard-pressed to find a large cap mutual fund that did not go right down with the market. Don't be caught being passively invested like that. What you want is active management. You want someone managing the downside as well as the upside. Also, don't get caught in the buy and hold trap. You have to remember that in 2008, when the market crashed, it started in December of 2007 and ended in March of 2009. Think about it. That was a 15-month period. Every month, people were getting their statements and they would ask their advisor what they should do.
And what was the mantra? Just hold. It always comes back. Sure it did, almost 4 years after it hit its bottom. We think that is unacceptable. It is also critical to understand what you are paying in fees. It continues to amaze us how little people understand what they are paying.
There are only two ways to grow a portfolio. One is by the interest and dividends being earned by the underlying securities, or what we call yield. And two, by appreciation, the idea that a security will grow in value. If I'm trying to grow to get a 6 or 7% return, and I'm only getting 2% in yield, and I'm paying fees of more than that, then my whole portfolio is relying on speculation. That's where you get volatility. We have all been taught you can't have great reward without taking great risk. It is not true. You can achieve market-like returns without volatility.
We have the tools today to show you how much risk you are taking. We have the tools today to show you how much you are paying in fees. Don't you think you have the right to know? To the first 10 callers, we will perform a risk and fee analysis for you absolutely free. If you had a life-threatening illness and the doctor was prescribing a critical procedure, well, wouldn't you find it appropriate to get a second opinion? You have saved retirement your whole life. Don't you think your life savings deserves a second opinion as well? Again, for the first 10 callers, we will do the risk and fee analysis and we'll show you how to avoid being just passively invested. Give us a call.
Welcome to True or False with Mike. Mike, I've got a couple of great questions for you this week. Are you ready?
I'm ready, Craig. Fire away.
All right, first, true or false? Most retirees and pre-retirees know the fees they're paying for their investments.
Oh, most know the fees? Is that what you're asking? All right. Obviously, that one is a big fat false, right? That is false as they come. It seems like almost nobody knows the fees that they're really paying. So, and folks, you're at home, you're watching this. I mean, think about it. Do you really know what you're paying in fees? I mean, every day people come in, they visit with us, and I'll bet, what percentage would you say people who even are close with what they're paying, if they had to guess?
I would say a lot of people think they know what they're paying, but they don't actually know the full story.
They think they know, but they don't know the whole story, right? So it's really common. They might come in and say, oh, I think I'm paying like 1% or something. I mean, we hear that a lot, right? But then, you do the research, and here's what happens. And here's what might be happening to you as well. Maybe you're in an account and you think you're paying 1% because that's what your advisor's charging you. That's what you see on the statement. Like a typical advisory fee is 1%. But then when you look at a list, here's a list of the different accounts that you have. You say, oh, look, I've got that mutual fund, this mutual fund, here's another mutual fund. Are those mutual funds free, Craig? No, there's more fees there, right? And here they are, they think they're paying 1%. At the end of the day, they're paying 2%, sometimes even 3%. That's crazy. And then if they have variable annuities on top of that, the fees can get to be outrageous. So do most people know what they're paying? No, obviously they don't. And folks, if you're at home watching, you want to know what you're paying, pick up the phone, call us here at the office. We'd be happy to sit down, run an analysis, and help you better understand the fees that you are paying your advisors.
Very good. Next, most investors clearly understand the risk they have in their portfolios.
So true or false, most understand the risk. All right, so I think we're going to have to nail that one as another false this week, right? We've got 2 falses this week, 2 are false. Yeah, most people think they're taking one level of risk and they're taking a different level. Now, would it be fair to say, though, that there are people that come in, they know they're taking a lot of risk, right? They come in, they say, look, I know I'm kind of taking on more risk than I should. Is that fair to say? Do we get people like that? Yep. And normally it's because they're thinking, well, what are the alternatives? Because historically what people would do is they'd put some money in stocks, some money in bonds. The idea would be maybe 50-50. But the problem is on the bond side, number one, because of interest rates, they're not paying anything. And number two, they all know that if interest rates rise, bond values fall. So they're thinking, why do I want to have half my money in something where I get paid nothing and I'm going to lose money over time? And that makes sense. So what have they done? They've kind of shifted their portfolios. They're buying more dividend-paying stocks instead of bonds. Or and by the way, folks, this may be happening to you. You might say, I got a 50-50 portfolio. I mean, I guess it was yesterday, we had someone come in, they had a 50-50 portfolio, half stocks, half bonds. You would think that they're, a little bit lower risk. But do you know that they were taking on as much risk as the market, as if they had 100% of their money in the market? They only had half their money in the market, but their portfolio, according to Morningstar, was taking on as much risk as the market. Now, why? Because the part that was in bonds, what happened? You know what bond fund managers are doing these days? They're saying, hey, we don't want to put our money and only earn 1 or 2%. Nobody will invest with us. So they're trying to get better returns. What do? Longer period bonds. They're going into junk bonds just to try to get better returns. But when you do longer period bonds and you're making them junk at the same time, it's like going in a stock. It has the same risk as a stock. So do most people know the risks they're taking? No, they don't. And folks, that's a problem. That can get you into retirement. So, I want you to call us because we can help you identify exactly where you are.
That's great. And folks, remember, if you've got questions about the risk you're taking or the fees you're taking in your portfolio or a question on anything, always feel free to give us a call and we'll help get you figured out.
You've worked hard for your money and your best is yet to come. You've reached a point where you don't put your money at risk anymore. The road ahead doesn't scare you because your money is secure and working for you. Centennial Wealth Advisory, portfolio stability, tax reduction strategies, lifetime income, financial security in any economy.
This week in IRA Focus, we are diving into the 3 things that you need to know about required minimum distributions. So when it comes to your IRAs or your 401ks, 403bs, 457s, simple IRAs, SEP IRAs, all of these qualified retirement plans, they all have what are called required minimum distributions. That means that when you reach a certain point in life, you must start taking money out even if you don't want to. You have to do it anyway. So let's talk about the 3 things that you need to know about these distributions. All right, number 1, the first thing you need to know, when do they begin? They begin when you hit the year in which you hit age 70 and a half. So here's what that means. Let's imagine that you were born from January 1 to June 30. So you're born in the first half of the year. Well, when do you hit 70 and a half? Well, you hit 70 and a half in the same year that you turned 70. So if you turn 70 March 15, you hit 70 and a half September 15. So the year in which you turn 70 is the same year you hit 70 and a half. Your first required distribution happens in that year. But what if you are born in August or September or something? You're born in the second half of the year. Well, then your required minimum distribution, when you turn 70 and a half, well, you'll turn 70 and a half in the following calendar year. That means your first distribution will come out when you turn, the year in which you turn actually age 71. Why do they do it that way? I don't know. I think it's stupid. I mean, come on. Why don't they just say, look, you turned 70 this year, you got to take your first distribution. That would be simple. That would be easy. But remember, this is the IRS at work, and nothing comes simple in that way. All right, so number 1 was the year in which you turn 70 and a half, that's when you start taking distributions. What's rule number 2, or most important thing number 2 you need to know about these IRAs and required distributions? Well, here it is. Number 2, every year you have to pull money out, and every year you have to pull out a little bit higher percentage. So here's what's kind of interesting. The way the IRS does this, and they do it, of course, in the dumbest way. What they do is they say, once you hit age 70 and a half, each year you look up on this table, we give you a divisor. So the divisor, it starts out at 27.4. So what you do is you say, you take your, let's say you have 100,000 in your IRA, you take 100,000, you divide it by 27.4. Why do they do that? Why don't they just tell you, hey, you got to pull out about 3.5% this year? 3.5%, oh, I get it. That's about $3,500. I get it. No, I've got to divide. I don't know about you, but I remember when I was in school, long division, oh, I hated it. Well, that's what the IRS wants you to do. They want you to divide. Well, then it's 27.4. What about the next year? The next year, the number might be 26.5. And the next year, 25.6, and then 24.7, and 23.8, 22.9, 22, and so on. Every year, the divisor gets smaller. Well, what does that really mean? It simply means that the percentage that you pull out is getting bigger. So every year, you have to pull out typically more and more and more. So again, if you want it or not, doesn't matter. You got to pull it out. And that brings us to number 3. This third thing you need to know about required distributions. What if you're stubborn, right? What if you're a stubborn person? You say, okay, I've done the math. I've got to pull 30 grand out of my IRA this year. But you know what? You don't need the money. You don't need it. Or maybe you only need a little bit of it, but you don't even need the 30 grand. You say, why in the world am I pulling 30 grand out? I don't need the money. I don't want the money. I'm just going to turn around and reinvest it anyway. Why do they make me pull it out? This is dumb. Hey, I feel your pain there. If you don't pull it out, now listen to this, if you don't pull it out, the IRS assesses a 50% penalty on you for not making your required distribution. And then you got to pull it out and pay income tax on the whole amount anyway. So you put 30 grand, 50% penalty, that's $15,000. Plus, you're going to owe tax on it, maybe $7,500. Before you know it, 75% of your IRA distribution goes to taxes because you were stubborn. Make sure you pull it out. So there you are, 3 things. Start at age 70 and a half. Number 2, it increases every year. Number 3, big penalties if you don't pull it out. So folks, if you have questions about this or anything else we talk about on this show, by all means, please feel free to give us a call.
Essential financial strategies for a comfortable retirement. Join the Centennial Wealth Advisory team for an informative and exciting presentation with complimentary gourmet dinner, and learn how to protect your assets from market volatility, how to plan your retirement, the best ways to generate lifetime income, how to safeguard your assets from unnecessary taxation, the difference between retirement advisors and Wall Street advisors, why getting a second opinion may be your most important financial decision, and much more. Choose the date and location that works best for you. Tuesday, November 29th at Boone's Long Lake Inn in Traverse City. Thursday, December 1st at Boyne Mountain Resort in Boyne Falls. Presentations start at 6 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 or visit send-wealth.com to reserve your seats today. There's no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 888-608-5825 today.
Welcome to Coffee Talk with Centennial Wealth Advisory. I'm Mark Canfield. I'm here with my colleagues John Torbett and Larry Flynn. And very often when we're in meetings with folks here in our office, they ask very common questions that we hear over and over again, and we thought it'd be nice to share those with you today. So the first up, we got a question here that gets asked quite often, I believe.
Yep, I'm going to fire it back your way here, Art.
Okay.
I know there are some new rules associated with financial advisors having to meet some new fiduciary standard. Can you tell me what that is about, and are you one?
Wow. Talk about a very complex question right now in the compliance world of investing. There's so many rule changes going on right now in the investment world, really trying to protect the investor. And all, I think, led with good intention for the most part. Making all investment advisors fiduciaries is the goal, meaning that you have to act in the client's best interest. Seems odd, doesn't it, that has to be made a rule. Centennial Wealth Advisory is a fiduciary and has been a fiduciary for some time now. So this rule change is really not anything too surprising really to us. But of course, with anything, there's going to be changes, and clients, you know, and people in the investment world, you're going to see those at some point or another come along where there's going to be additional paperwork. There may be some disclosures you're going to have to sign, and so on and so forth. Everybody's still kind of working through and wading through this Department of Labor's ruling to really get to the bottom of what all this means. You know, Larry, you've been in the investment world for a long time. You've seen some of these new rules come and go, and I think we were talking the other day. You said the best thing there's, you know, overall, is it really going to make a difference in what the way maybe a financial advisor makes a recommendation? You know, probably just another 20 pages of paperwork, right?
Yeah, I mean, I hope it does. I mean, they've now made it the law that, you know, somebody has to, an advisor has to act in the best interest of the client, right? But, you know, it was kind of watered down in the sense that it didn't stop them from selling anything they wanted to sell. So, you know, they're going to still be able to sell anything they want. Now they just have to prove that that was in their best interest, right? They have to enter into a best interest contract with them. I just hope that contract doesn't look like a prospectus with a mutual fund where they're basically people are signing away all the disclosures because it was all in this fine print that they did not read. You know what I mean? So.
And wasn't the statistic that you found on, I think TD Ameritrade did the study and found that, like, what, 5% of financial advisors fell under the fiduciary standard. So basically 5% fell under this fiduciary standard, which we're proud to say Centennial Wealth Advisory is part of that 5%. But that means 95% fell under the suitability standard, where they just had to recommend suitable investments for clients. So
probably the good thing out of this that I think is going to come out is now at least the law that they have to act in the best interest. So you're probably going to see people have a lot more lawsuits where they find the advisor wasn't acting in their best interest. I mean, there's a little more teeth in it now that people can fall back on.
right.
Yeah. Well, let's ask a question here. I wish I'd have known about Roth IRAs sooner. So how can I get into them if I have everything in a traditional IRA right now, if I should get in at all?
Yeah. People love Roth IRAs. I mean, when they can look at them and say this is a pot of money that tax has been paid on and it's grown tax deferred, and now when I take it out I don't have to pay any tax on it at all. I mean, wouldn't you want ideally everything in a Roth, right? So as soon as people hear about it, they think, all right, how can I get into them? Unfortunately, they've been probably part of a 401k their whole life, or been putting into their IRA, and now that pot of money they have is all taxable. So now they're saying, how can I get that from this pot to the other tax-free pot, right? Well, unfortunately, they can't necessarily contribute any longer to a Roth, especially if they're not working, right? If they are, they might want to start, or if they have a 401k that has a Roth option, you're finding people now starting to do more of that. But really, their only option is converting their IRA to a Roth, and that's a pretty tricky situation because now you got to pay tax on that, right?
Right, and that's where annual tax planning needs to play a role in your overall retirement plan. I mean, you should be looking, not investments are obviously a very important piece, but the tax side of it is just as important, if not more important, especially when you're getting to that stage where, okay, now I'm getting to closer to retirement. How is this income going to look like for me in retirement, and evaluating what taxes you're paying today versus in the future, and then ultimately evaluating if Roth IRAs should play a role.
It always makes me scratch my head when people are putting money in blindly and not looking ahead at the future, not doing tax planning, as you said, John. Larry, with your tax experience, this idea that you were saving money, putting in an IRA, sounds great, right? But then when people get into retirement and they want to pull money out, they're not so happy about that great plan at that point. But so consider it, right? Look ahead, plan for that.
Right. Yeah, I mean, the idea was we're going to save at this rate because we're in our working years, and then when we pull it out, we're going to be in retirement. We're going to be in this lower bracket, right? That's the idea. Typically, right, guys, we're finding 90% of the time clients are pretty much in the same tax bracket, same lifestyle. Really, all they did was kick the can down the road. So,
yeah.
Well, thank you for joining us on another segment of Coffee Talk with Centennial Wealth Advisory. If you have any questions that are similar to this or different that would help you, please give us a call at the number on the screen, and have a great day.
Thanks everyone for watching the show today. Now, if you have any questions, feel free to call our office or visit our website. And remember, you only retire once, so let's get it right the first time. We'll see you next week.